This video explores into the fundamentals of IFRS accounting standards and principles. The requirement for consistent and open financial reporting standards has become essential in today's interconnected global economy. The International Financial Reporting Standards were established as a collection of globally accepted accounting rules aimed to standardize cross-border financial reporting procedures. The International Accounting Standards Board, IASB, develops and maintains a set of accounting principles, standards, and interpretations known as IFRS, International Financial Reporting Standards. The International Financial Reporting Standards, IFRS, are intended to offer a common language for financial reporting, making it easier for businesses and investors to interpret and compare financial statements from various countries. Unlike generally accepted accounting principles, GAAP, which are primarily applied in the United States, International Financial Reporting Standards, IFRS, are widely utilized around the world. The International Financial Reporting Standards, IFRS, are based on a collection of basic ideas and concepts that guide the preparation and presentation of financial statements. The International Financial Reporting Standards take a principle-based approach, providing general suggestions rather than specific requirements. This adaptability enables businesses to apply rules in a way that best reflect the financial nature of transactions. Financial statements prepared in accordance with IFRS must provide a truthful and fair picture of a company's financial situation, performance, and cash flows. Information is significant if leaving it out or getting it wrong can influence people's decisions. When information is vital, it should be shared or made public. The goal of IFRS is to make financial statements comparable across businesses and industries. Investors and other stakeholders are able to make relevant comparisons. IFRS, like GAAP, highlights the need of long-term uniformity in accounting policies and practices. IFRS expects that a company will continue to operate in the foreseeable future. However, if the company's viability is in doubt, they must provide more information to the public, such as in a special report. The International Financial Reporting Standards have made a significant impact on the worldwide businesses and financial landscape. IFRS is employed by over 140 nations, including the European Union, Canada, Australia, and many emerging economies. This widespread acceptance has simplified cross-border investment and made reporting financial results easier for international corporations. The transparency and comparability of IFRS benefits investors by improving their ability to evaluate investment opportunities across multiple markets. Companies with operations in different countries might save compliance costs by following to a single set of accounting rules. By offering a common financial reporting structure, IFRS has helped to integrate global capital markets. Companies are encouraged and in many cases forced to comply with international financial reporting standards for a variety of compelling reasons, such as when a company expands globally, it frequently conducts activities and raises finance in various countries. The International Financial Reporting Standards establish a uniform language for financial reporting, making it easier for companies to convey their financial performance to a global audience. This is essential to attracting foreign investors and ensuring cross-border transactions transparency. IFRS increases investor trust. Domestic and foreign investors are more willing to invest in companies that adopt globally accepted accounting standards. Financial statements prepared in accordance with IFRS are regarded as reliable, transparent, and comparable, reducing the gap in information between companies and investors. Many stock markets throughout the world, including those in Europe, Asia, and Australia, require companies to prepare financial statements in line with IFRS in order for their securities to be listed. Compliance to IFRS opens the door to a large pool of possible investors and financing sources. IFRS encourages financial statement consistency and comparability. When companies utilize the same set of accounting standards, it makes it easier for investors and stakeholders to examine and compare financial data across companies and industries, resulting in better decision-making. Compliance to a single set of accounting standards, IFRS, streamlines financial reporting for global firms. It removes the difficulty of maintaining numerous accounting systems and complying with different local regulations, lowering compliance expenses in the long run. IFRS is based on principles which allows businesses to modify their accounting rules to better reflect the economic substance of their operations. This adaptability might result in financial statements that more accurately reflect a company's financial status and performance. Many countries order companies to use IFRS, especially if they are publicly traded, operate in regulated areas, or have international subsidiaries. Non-compliance can lead to legal consequences and harm a company's reputation. When companies participate in cross-border mergers and acquisitions, having financial statements prepared in compliance with IFRS helps speed up due diligence and smooth conversations. It also helps in determining the worth of assets and liabilities across multiple jurisdictions. When a company has subsidiaries in several jurisdictions, IFRS provides advice on how to consolidate financial statements. This guarantees that a company's consolidated financial accounts represents its global operations appropriately. Adoption of IFRS is frequently associated with enhanced corporate governance and accountability. Companies that adhere to internationally accepted accounting standards are more likely to implement strong internal controls and ethical business practices. Complying to IFRS standards is essential for businesses functioning in a worldwide economy since it promotes transparency, simplifies access to finance, boosts investor confidence, and decreases compliance difficulties and cost. Finally, IFRS compliance adds to better informed decision making and assist companies in maintaining their credibility and competitiveness in the global marketplace.